Coming to India trends, as we know, was the RBI policy where the MPC voted 5:1 to keep the policy rate unchanged at 6.5. The stance was retained at withdrawal of accommodation. The external MPC member, Professor J.M. Verma, voted against the stance, as well as voted for a 25 basis interest rate cut. And of course, the thought process behind the voting for an interest rate cut will be revealed in the MPC minutes, which will be released at the later part of this month. But overall, if you look at the tone of the MPC policy, the growth outlook was positive. In fact, if we can, as we can see on the bottom table on the right hand side, compared to the if you look at growth rates from 7% growth expected in FY24 in December 23. The RBI revised the forecast taking into account the NSO estimate of 7.3. Even if you look at FY25 growth estimate for Q1 of next fiscal year, RBI revised the forecast from 6.7 to 7.2, from 6.5 to 6.8, and 6.4 to 7. So broadly, on an average, RBI is projecting a 7% real GDP growth, which is slightly higher than most of the professional forecasters, as well as multilateral agencies like IMF, World Bank estimates. Of course, RBI has taken comfort from improving household consumption as inflation continues to come down, from strong government's commitment to capex, as well as improvement in agriculture growth as well. If we look at CPI inflation projection, RBI compared to 2024 inflation estimate for 5.4, CPI inflation has projected at 4.5 for FY25. The overall tone of the policy was in line with the December 23 policy, where RBI, mentioned that they need to be actively disinflationary to ensure that inflation aligns to their 4% target. So just to give a background, there was a widespread expectation before the MPC policy that RBI may change stance, or they may bring up an action plan to address the tight liquidity. So while the liquidity number is not very materially negative, the problem the banking system has been facing for a while now is the skewness of liquidity, which has kept overnight market rates about 20 to 30 basis higher than the RBI policy rate. So there was an expectation from RBI that RBI will probably do something. But if we look at RBI's action since January, RBI has been intervening intermittently through fine-tuning operations to provide liquidity to the banking system. It has also undertaken various measures, even in the December policy, to provide liquidity during the weekends. So RBI kind of separated between the needs and wants of the bond market. So while RBI is trying to ensure that a predictable liquidity which the market needs, is provided actively, but what the market wanted, that stance change, which would have probably provided a greater clarity on RBI rate outlook. RBI decided to retain the policy flexibility given the uncertain, global cues, as well as RBI probably wants to wait for the trajectory of inflation to pan out as per its projection. But if we look at the big picture, whether the market participants were disappointed yesterday or not, the big picture is that RBI is expecting an inflation of 4.5% for FY25. So even if there is not a material slowdown in growth for India, as long as inflation is moving broadly along the expected lines, we do expect interest rate cuts of 50 to 75 basis in this calendar year itself. Given that inflation is moving materially close to RBI's 4% target for most of the quarters. Typically and historically, RBI has maintained a real rate that is a difference over the expected inflation of somewhere between 100 to 150 basis points. Typically, in a slowing economy, RBI prefers to maintain a slightly tighter real rate, and at times of economic expansion, RBI prefers to maintain a slightly wider real rate band. So even if you are assuming 1.5% real rate for the economy, assuming a no major slowdown, it still translates to at least a 50 basis policy rate cut in this calendar year. So we think that we can focus on the big picture, while the timing, like we said, just like the global central banks, the timing for RBI is ultimately their own individual assessment versus the market assessment of the demand supply dynamics. Uh, in terms of inflation or the growth dynamics, but largely the end goal I think is quite consistent with market expectations.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.